Welcome back to Wealth Mavericks, the only podcast where we share the secrets the wealthy know to build generational wealth. And in today's episode, we're going to continue the conversation of the 4 stages of an asset. Last episode, we covered the contribution phase of an asset, and today we're going to kick it off with the accumulation phase. How does this vary from asset to asset? And what are the tax implications of each asset? So we're looking forward to continuing this conversation. Hope you enjoy this episode.
With a 401k, because we didn't pay taxes on the contribution stage, we didn't pay taxes on the accumulation stage, now we got to pay income taxes on the distribution stage as income at the time of our tax bracket at distribution. In a planning process, using the tool belt of multiple assets, you can actually yield a tax zero plan. That's the contribution. Now, because we put 10,000 into each of these 2 assets, now we're entering the accumulation stage. How's that money going to accumulate? I don't know. You get to choose stocks, bonds, mutual funds, ETFs, real estate, whatever, however we've designed it, right? And there's a lot of different options of doing that. Now you've entered the accumulation stage. Okay. In both of those assets, the government says it's tax deferred. Okay, meaning that when that money accumulates and it grows, you don't have to pay taxes on that growth. Okay, where normally you would if it was outside of a retirement account. You would have to pay.
What would that look like? So what would the taxes on that, what would it be? So in the so if we're taking these 2, and I like this comparison because I think this makes it easy for everyone. And again, my grandma used to say, "Oh, you're just giving me the yeah. Like you're not really listening. You're just kind of yeah." And I think a lot of people live in the yeah when it comes to this stuff. They like nod their head and they agree and they're like, "Oh yeah, I get it," and they don't get it. And so then they lack really that in their life, that real advice. So we're talking about a 401k and we're talking about a Roth, right? And we're saying, and just for the sake of example, $10,000 goes into both of them. The 10,000 on the 401k in the in the contribution phase is tax deductible. So they get essentially that full $10,000 worth. Both of them, $10,000 goes in though, right? It's just one of them you don't have as much of a tax deduction. So there's the math there. And then as they're accumulating, what do you mean they're both tax-free in the accumulation? What would be an example of something that's not tax-free in the accumulation phase?
Sure. Let's use something very, very simple as a CD, a certificate of deposit at a bank, right? Okay. You put that same $10,000 into a CD at the bank, and the bank says, "Oh, you can put it in here for 10 months and we'll give you 5%. Okay. After that 10 months, they give you your 10,000 back plus 5%. That 5% is taxable.
And is that like cap gains?
Excuse me. Yeah.
Okay, so cap gains would fall into this accumulation.
Cap gains, it could be interest, it could be dividends. Those are all different areas, but that's the point. It depends on what the asset is that creates the 3rd stage distribution, which we're not at yet. So don't go ahead.
Okay, I won't go ahead. but looking at the mechanics of this, and the same thing is going to happen for a business. If you start a business and you grow a business,
because it's an asset,
obviously no taxation going in. You're just funding it. There's this accumulation, which is going to create cap gains upon the next stage. So
that's correct. Keep going. Yeah. So that's really the driving force of why people, and really when the 401ks and IRAs and retirement accounts came out, and then later on the Roth came out, was, hey, you don't have to pay taxes on your growth. It can your compounding can accumulate your money even more, right? So contribution, 1st stage, accumulation, 2nd stage. Now the accumulation stage is the longest stage of all these assets. Okay, because once you make a contribution, you're done. Now, you can make multiple contributions, but that's an action and a one-step thing that only occurs at that moment. Okay. Now, the accumulation is ongoing. even after the third stage of distribution. Distribution is income. I'm going to take money out of my 401k. I'm going to take money out of my Roth IRA. Okay. Now, if I take it all out, then obviously accumulation stops, right? But people don't do that, right? They take income, they take portions out. So let's talk about 401k first. So I get to 59 and a half or older, which is the rule to be able to have access to your retirement account. There's other certain ways that you can access your money sooner. We won't go through that right now, but 59 and a half, I hit retirement. I want to start distributing and taking income out. Now with a 401k, because we didn't pay taxes on the contribution stage, we didn't pay taxes on the accumulation stage, now we got to pay income taxes on the distribution stage as income at the time of our tax bracket at distribution. So current. So if your income skyrockets or tax rate skyrocket or whatever, doesn't matter. That's your tax rate right then in that moment. Okay. So distribution is where you start taking the money out. So to my point of the CD is the distribution didn't occur on my own. It occurred because the asset design was, hey, after the 10 months, you're getting your principal and interest. So the distribution was forced on me, and therefore the IRS has a taxation on that distribution, which is different than a 401k because I said income taxed. The reason being is because a 401k retirement accounts are designed to replace income by purpose. The tax rate is higher. So the government needs tax revenue. And so they tell you and I, put money into retirement asset to take out income later on, which is the distribution creates taxation. Now a Roth IRA, when I take that distribution after 59 and a half, is not taxed. There is no income tax. Well, why, Bob? Because you pay tax on the contribution. You already pay taxes. So it's after tax dollars versus the 401k is pre-tax dollars. Okay. Now in a 401k, you have those two options. You can put in the pre-tax option to get a deductible expense on your contribution, or you can use the Roth version of the 401k, pay taxes on that income, but you still make that contribution of 10,000 into your 401k Roth IRA.
Wait, so you're saying
sorry.
people can elect to pay the taxes on the 401k up front? Like it's
Correct.
like a box that they check and
Yep.
and then they pay on it? Okay.
Yep.
And
Yep.
and then they just don't claim it on the taxes for that contribution.
That's correct.
Okay.
That's correct. So those are the three. Go ahead, Aaron.
Well, so when someone asks you what is the better option, I know you said you want multiple tools and you probably want to diversify, but if you were just going to pick one, like for a younger person starting out, it's kind of a roll of the dice, isn't it? Like paying the taxes now or paying the taxes way later?
Yeah. So that's a great question. And that is part of the scenario of planning is which asset is better at which time for what reason. Right? That's you got to figure that out. And it's art and science because it changes. We change, our lives, events change. So for somebody younger, I always like the idea. This is my personal opinion, and I'm not giving advice to anybody about this. My personal opinion is if you're younger, I would recommend doing the Roth because you have enough time for that to compound, accumulate, and grow tax-free, deferred, to where when you take the money out at after retirement age, 59 and a half or later, you actually don't pay taxes. So there's really no deferral. So you can actually have a larger sum of money over that period of time, completely tax-free. Now, my belief is at some point, the government's going to put a cap on that, right? And if you have a certain amount saved up, anything above that, you're going to have a surcharge and a tax. And they've actually been talking about that with IRAs and 401ks actually currently. I think the number is like 3.4 million or something like that. Anything above that is too much money. You saved too much money. You were too disciplined. You listened to us. Shame on you. You should pay taxes for listening to us over these 30 years of accumulating and growing and making good business and personal decisions. You hear the sarcasm, but that is why I talk about laws and regulations being the worst economic termite of all the economic termites. They get to change the rules on the rules whenever they feel like it, even though we follow the rules. It's like, hang on, that's not cool. It's like watching a basketball game and all of a sudden a guy dunks and the referee blows the whistle and calls a foul on him. Like, what? I know I scored, I dunked the ball. He's like, no, you're not allowed to do that anymore. Well, since when? Just now.
Since
What
I said so.
Government.
Right? That's essentially what's happening to us. Right?
So as we're diving into this, I mean, I think this is one of the reasons why I think people need to have advisors in their world who understand what they're talking about. Not necessarily just tried and true advice, that is blasé and just, cookie cutter for everybody. Each person's scenario is different. And we work with mostly business owners or people who are transitioning into business ownership. And there's a very different scenario that business owners have. And so I think it's really, really imperative early on in your process to get a plan in place, create a plan, and then execute that plan.
Yeah.
So as we're jumping into, I do want to cover the fourth stage, and I can think of a few scenarios, at least in my head, of where this like really becomes applicable and actually makes a difference. And I'm surprised no one else is talking about this because it is an important part. But talk to us about, I mean, this fourth stage. I think we understand, contribution, like you're putting money in, there's, taxation or not taxation, the accumulation phase, there's assets that do all that. In the distribution phase, there's, and ideally what I remember when I was buying my first like real bike, like for like competitive, events and triathlons and stuff. And they're like, fast or no, light, strong, cheap, pick two. You're like, if you want something that's strong and light, it's going to cost you a fortune. If you want something that's light, it's going to be weak if it's going to be cheap. And so it's almost like you kind of have to pick one of those phases, and like you're not going to get all of them. The government's just not going to allow it. And I'm sure that there's some assets that are like doubly negative, so there might be some non-beneficial things. But as we're talking about this fourth stage, tell us what it is and why it matters.
So what I like to do is when people ask me, well, Bob, which asset do you think is the best? Because there's no silver bullet, to your point, right? That really the government's going to give you an asset that allows you to be 100% tax-free at all the times. You can do that, but if you make over $1 of income a year and you can only contribute 50 cents a year, right? I mean, they're going to make it so ridiculous, people aren't just going to do it, right? But in a planning process, using the tool belt of multiple assets, you can actually yield a tax zero plan, right? Some assets pay taxes, some don't. How do they offset? So anyway, so the transfer part is really, really important because it really depends on the plan. It depends on the outcome of the client and what their goal is, and it depends on the assets that they have. Okay.
So is like an example of that, like I know in multifamily, I know we have a whole series of episodes with Pat, but is this like 1031 exchange? I mean, it's like you actually, the money was distributed, but it's transferred in a different way than like just to my bank account.
So following what the IRS tells us is a great guide. It is a roadmap. And the IRS tells us there are 3 assets that are the best assets for all of us to be in. Now, again, I'm not telling you what to do. I'm just saying this is what the IRS says. Okay. Now, how do I know this? Because of the best tax benefits. If the IRS gives you the most tax benefits of a particular asset, they're telling you, we want you to do that. Okay. Of the 3, one of them I think is one of the best and most cost-effective ways to allow the other 2 assets to accumulate. But most people don't like it because of what it's called. Okay. So I bring this up because this is important when it comes to transferring, because all 3 assets are effective in the transferring to where you and I can have more cash and more value. And they also have the ability to appreciate in the most tax benefit way. All right. So transfer is basically what it sounds like. I'm transferring, right? I'm transferring my cash, my asset somewhere else. Okay. So obviously we all know the first thing that comes in our head is death, right? I die, my money goes to my heirs or charity or whoever. Well, that's part of the plan. You get to choose, right? And if you don't choose, the government chooses for you, right? Which will be your next of kin, which may be the oldest, your only child who's strung up on drugs or has had issues or whatever, and you don't want to give them the money, but you want to give the money to the church, but you never planned for it. That government's just going to say first of kin, right? So transferring is a very important stage because we get to dictate what we want our assets to do and how. And there's actually, if you look at legacy planning, meaning estate planning, there's an entire list of laws and tax code that lawyers abide by for just estate planning to do what? Transfer assets to other assets or other strategies. For example, life insurance. Life insurance at death pays a death benefit. Well, in estate planning, you can have that death benefit pay the taxes of your estate. That's the whole point of it. So you don't have to pay taxes. You just pay a premium for the death benefit. Death benefit pays the taxes. Your heirs get the rest of the estate. But each asset has a different transfer rule. Real estate, to your point, yeah, I can do a 1031 exchange. 1031 is actual tax code that says I can sell my property, my real estate, follow these rules to a 1031 exchange, and I can transfer all my gains to a new real estate asset and not pay any taxation. The same thing with life insurance, 1035 exchange. Again, the tax code is 1035. Which one came first, chicken and egg? 1031, because it's 1031 versus 1035.
Makes sense.
Right? But you can do the same thing. You can transfer cash from one contract, insurance contract, to another one with no taxation. So what's the IRS telling us? They want more of that because they're allowing us to make these transfers without taxation.
Mm-hmm.
Why? Because it benefits the government. It's the only reason why they give us tax benefits is that if it benefits them. Plain and simple. They're very selfish. It's okay. But they're a business. And their business is to run their assets to create what? Revenue. What's their revenue? Taxes. So everything they do is to generate revenue, which is taxes. Why are we upset at that? We're trying to do the same darn thing in our lives. You just got to acknowledge and recognize it.
And I've heard you talk about this too, Bob. It's like they give us the clues for how to do these things. So when we talk about the tagline for Wealth Mavericks, the secrets the wealthy know to build generational wealth, I've heard you share this with so many different people, but the strategies that we can put in place in order to utilize what the government has given us in order to maximize that. We had Aaron and Bob and I think it was last week, had a conversation about the Rockefeller family versus the Vanderbilt family and the strategies that they used to either keep, you have to do some research on your own to find this out. But one of the families still has, 200 plus members of the family that have the original wealth. The other family has no family members who have original family wealth. So there are systems that are put in place in order to do that. So I think what in our members only content from today, what I want to talk about. So if you're not a member, become a member so that you can get access to this deeper level content. But how do we have that net zero tax effect by combining assets? And I know, Bob, you talk about the three best assets as the IRS kind of leaves those breadcrumbs. So we're going to talk about in the members only content, we're going to talk about the three best assets as the IRS dictates, and how to use those to net zero on your tax. So make sure to join us over on the members only content, wherever you access that. And I just want to say thanks to everybody who's listening to this. You know, you really are set apart from other people who are just going through life and experiencing life as it comes to you. You're listening to this podcast because you're serious about really building wealth, building generational wealth. And if you just take the things that Bob is sharing with us and apply these in your life, have your advisors listen to these episodes, share it with other people. Our goal is to help as many people as we can. And so we hope it's having a positive impact. If you want to join the conversation, make sure to head over to Facebook and join our groups over there. Or if you're watching this on YouTube, drop in the comments what questions you have. We read every comment that comes in. By the way, that's not a whole lot right now. So put those comments in there so we can really customize this content to answer the questions that you've got specifically. So until we talk to you next time, go be a wealth maverick.